We are starting a new video series starting from video 101, and the entire content is based on JAIIB and CAIIB syllabus based credit lending topics. In this channel, various credit lending topics based on JAIIB and CAIIB latest syllabus will be discussed in simple language through small videos. It is certain that those who read and understand the topics covered in the videos will find it very easy to appear in the JAIIB and CAIIB examinations and also in the Diploma in Banking and Finance examinations. The reference to the first topic, that is the cardinal principles of lending, is based on the topic given in Principles and Practices of Banking Module B, Functions of Banks, Unit 22. Today we shall be discussing the cardinal principles of lending. The founder of this channel is a retired banker with 36 years experience. He had served two banks for 28 years. He also served as a senior faculty and consultant with a reputed bankers training college for 8 years, teaching mainly the lending topics starting from basics of lending to advanced credit management. He still continues to be a freelance trainer in banking subjects. Banking is defined as accepting deposits for lending and investment. Major portion of bank's income is derived from the interest it earns on the funds lent. Banks are commercial institutions. They are profit oriented. Sometimes funds lent may not come back as expected. The bank will not be in a position to repay the depositors when they come to withdraw their deposits money. The cardinal principles of lending. The bank has to adopt a cautious policy and follow certain principles to minimize risks while lending money. Though the risk can never be eliminated, following these principles may result in reduction of risk to certain extent. These principles are known as the cardinal principles of lending. The cardinal principles of lending are applicable both for retail lending, that is lending to individuals like home loan, car loan, personal loan, etc., and wholesale lending like lending to business enterprises. The cardinal principles of lending is subdivided into 6: safety, liquidity, profitability, purpose, diversification, and security. Safety of funds lent. The bank should ensure that the advance is safe and the money lent will come back. Thus, the financial soundness of the business which has borrowed the money, integrity of the borrower, and the ability of the borrower to run the business successfully are very important. The repayment of loan depends on capacity to pay, willingness to pay, and income generation. Liquidity of bank's fund. Deposits are payable on demand. Banks should have sufficient funds to meet the demands of the depositors. Banks have to maintain sufficient liquidity by way of cash surplus. Banks prefer to lend for working capital purposes which are short-term in nature. Working capital means finance required for day-to-day operations of the business. Short-term means valid for a period up to 12 months. Working capital finance is payable on demand. The borrower has to repay the loan as and when demanded by the bank. The liquidity aspects is taken care of by bank's assets liability management department. Profitability of the bank. Banks are commercial organizations and profit earning is the motto of the banks. Banks will have to pay dividend to investors. Banks have to create sufficient reserves to meet future requirements. The bank has to pay interest to depositors, pay salaries and wages to the employees, incur administrative and staff expenses. The purpose for which finance is sought. Before sanctioning any advance, the bank should ensure the purpose for which the advance is needed. The purpose should be productive and not speculative. The advance must be granted for productive purposes as it increases the earning capacity of the borrower and ensures prompt and regular repayment. The money lent should not be used for purposes such as gambling or hoarding of food grains, etc. Diversification of risk to avoid concentration risk. Every advance given by banks is subject to risk, which may result in default of the loan. The business units financed by the banks have to face various business and economic instabilities. This may paralyze the business and have an adverse effect on their profitability and may result in non-repayment of the loan. Therefore, banks follow the principle of diversification of risk. Banks should not concentrate their lending only in one direction. It is better to lend to a large number of borrowers than lend to one big business. All the borrowers may not become defaulters at the same time, but if one big borrower makes a default in repayment, a large amount of the bank money gets blocked. Similarly, the advances must be granted to different sectors or different industries as instabilities may not be faced by all industries or sectors at the same time. Example for non-concentration risk. There are two banks, ABC Bank Limited, PQR Bank Limited. They have total exposure of 2000 crores. The ABC Bank Limited has given 1000 crore to two accounts. Share the concentration risk is 1000 divided by 2000, 50%. Whereas the PQR Bank Limited, the total exposure of 2000 has been given to 5 accounts each of 400 crores. There the concentration risk is 400 divided by 2000, which is 20%. So to avoid the concentration risk, the number of accounts need to be increased. Example for sectoral concentration risk. Taking the same example, the ABC Bank Limited, out of the 4000 crores, 3000 crores have been given to cotton textiles, which consist of 75% of its exposure. Other sectors is 25% constituting 1000 crores. Whereas the PQR Bank Limited, total exposure is 4000 crore, cotton textiles it has given 1000 crore, aluminium industry 1200 crore, automobile industry 800 crore, steel industry 1000 crore. So if you take the percentage of exposure to cotton textiles it is 25%, to aluminium industry it is 30%, to automobile industry 20%, and to the steel industry 25%. The probability that all the sectors cotton, aluminium, automobile and steel may suffer setback is a remote possibility. This is how the concentration risk is avoided by diversifying the loan portfolio. Security. The primary source of funds for repayment of a loan is from the profits of the business itself. Banks take considerable care to evaluate the profitability and sustainability of the business financed by them. Despite all care and due diligence, some of the businesses could fail. The cause of failure may be due to external factors or mismanagement of the business. Banks have to ensure that even if the business fails, their funds are recoverable. Recoverability of loans in such extreme cases of failure of the business is ensured by taking security. Evaluation of security. The securities may be a plot of land, a building, a flat, a shop, ornaments, insurance policies, shares, debentures, bonds, etc. Banks take security from the borrowers to protect themselves in case of default of loans. In the event of default, bank can liquidate the security and credit the proceeds to the loan account. Thus, the quality of the asset, either primary or collateral, plays a very important role when an asset is accepted as security. For the security, we follow MAST principles: marketability, ascertainability, stability of price, transferability. The following four attributes are referred to as MAST principles. Marketability. Security should be such that it can be easily sold or converted to cash. Ascertainability. Value of the security should easily be measured or found out. Stability of price. Security value should not be volatile or must not vary too much. Transferability. Security should be easily transferable in bank's name or in the name of buyers. With this, the cardinal principles of lending is completed. Subscribe to my channel, which is totally free of cost. Subscription will give you intimation on the new videos published. More videos based on JAIIB and CAIIB syllabus based credit lending topics are to be published. Thank you very much. The YouTube channel is NPI's Learning Modules in Lending, JAIIB syllabus based credit lending topics.